Why is US dollar to Japanese yen rising despite intervention risk? How high can US dollar to Japanese yen go before the Bank of Japan steps in? This US dollar to Japanese yen forecast for June 2026 breaks down the yield differential trade, the 160.00 gamma wall, and the carry trade flows driving institutional positioning. There is one number in the market right now that is setting a perfect trap for breakout chasers and dip buyers at the exact same time. That number is 160.24 on US dollar to Japanese yen. And as you're watching this, institutional positioning is piling into a trade that could either deliver a 200 pip melt-up or a liquidation freefall that erases weeks of gains in 2 hours. There is one danger zone and one hidden opportunity right here. I'll show you both. Stay to the end, because I'm giving you 3 exact levels you can trade today, complete with precise entry triggers, stop losses, and risk-to-reward ratios that exploit the real story nobody is telling you about the Bank of Japan. Right now, the market is pricing a 25% chance of a BOJ rate hike at this week's June meeting. That's the surface narrative. But the real trap is not the rate hike itself. It's the expectation of hawkish forward guidance versus another dovish disappointment. And that is why the price is pinned like a compressed spring just above 160. With every moving average across every time frame screaming strong buy. Write this number down. 159.96. That is the pivot point. If US dollar to Japanese yen breaks below 159.96 today and holds, the entire short-term bullish structure resets. And we are looking at a rapid unwinding toward 159.50 and then 158.80. But if we stay above 159.96, the path of least resistance is a grind higher that tests the yearly highs, and that is where the intervention ghost becomes a live grenade. Look at the monthly trend, strong buy. Weekly trend, strong buy. Daily trend, strong buy. 5-hour and 1-hour trends all aligned strong buy. This is not a market that is topping out quietly. The ADX reading of 36 confirms a powerful trend, not a weak drift. Yet the CCI is only at 45, far from overbought, and the RSI is resting at 58, plenty of room to run before exhaustion. So right now the herd is overwhelmingly positioned long, riding the momentum, but they are ignoring one structural fracture that is about to show itself. The 200-week moving average is all the way down at 156.27, and the 100-day moving average at 158.11 is climbing fast, but the real brick wall isn't below, it's above. Most traders are staring at the 160.63 resistance, thinking that's the breakout trigger. They're wrong. I'll reveal what really matters in a moment. First, let's build the technical map from the top down, because the weekly and daily pictures have a hidden conflict that will catch the over-leveraged exactly at the worst time. On the weekly chart, price has now posted 3 consecutive closes above the 20-week moving average, which sits at 159.75. That's your dynamic support magnet. Every time we've pulled back to that level in the last 4 weeks, buyers have stepped in aggressively. The 50-week moving average at 159.05 is sloping up sharply, confirming trend maturity. MACD on the weekly is printing a solid histogram bar above the signal line, no bearish divergence in sight. That screams continuation. But shift down to the daily, and you see something subtle. Although price is above the 20-day MA at 159.75 and the 50-day MA at 159.05, the daily MACD histogram has started to flatten, not cross bearish yet, but the momentum compression is real. That's normal before a breakout, but it also means that any false breakout will generate a brutal snapback. Now drop into the 4-hour time frame, because here is what most traders miss. We have a full alignment of moving averages stacked bullishly, MA20 at 159.75, MA60 at 159.05, MA200 at 158.11, all angled upward like a staircase. But look at the MACD on the 4-hour. It's still positive at 0.370, but the signal line is catching up and the histogram bars are shrinking. This is not a roaring expansion, it's a coiled spring. Whenever you get ADX above 35 and MACD compressing on the 4-hour right under a major resistance cluster, it creates a volatility vortex. Either price explodes through 160.63 and traps late shorts, or it rejects violently and hunts the stops of breakout longs resting just above 160.41. The 4-hour candle close behavior around 160.41 will be the tell. If a 4-hour candle body closes below 160.41 after poking above, that is a failed breakout and your short trigger. Until then, momentum bias is long, but it is fragile. On the 60-minute chart, we are holding above the 20-period MA at 160.17 and the 10-period at 160.08, with a short-term stochastic at 63, not overbought, not oversold. Williams %R is at -25, indicating mild bullish pressure but no extreme. Volume is thin this session, which is typical ahead of a central bank event, and that thin liquidity means price can be pushed around easily by headline noise. Immediate resistance levels are pinned at 160.41, then 160.63, then avoid up to 161.20 if intervention doesn't appear. Supports stack at 159.73, 159.51, and the critical floor at 159.28. The ATR is 0.48, so the expected daily range is roughly 48 pips. That means a normal day takes us either to 159.76 or 160.72. The pivot at 159.96 is the midpoint. Holding above it keeps the intraday bias long. Here's the retention bridge. The next signal changes everything. If you're only watching the US dollar to Japanese yen chart, you're missing that this move is being driven tick for tick by the US-Japan 10-year yield spread, and that spread just printed a hidden divergence against price that is the real danger signal. Let's connect the fundamental driver and cross-asset linkage now because the last 24 hours of news completely reframe the risk. The core headline is the BOJ preview for the June meeting, where analysts now assign a 25% probability of a rate hike. That may sound low, but just 3 weeks ago it was 0. The shift comes from a series of hawkish comments by BOJ board members suggesting that inflationary pressures are broadening and that the yen's persistent weakness is importing too much cost-push inflation. Overnight, we heard one key official mention that the central bank must be data-dependent but not passive, which markets interpreted as a green light to price in a tighter policy path. Yet the US side is equally defiant. Fed funds futures are still pricing only one cut this year, and real yields remain elevated. That keeps the US-Japan rate differential wide open, fueling the carry trade that buys US dollar to Japanese yen on every dip. But here's the hidden divergence I mentioned. The US 10-year yield minus the Japanese 10-year yield spread has been range-bound for the last 5 sessions, while US dollar to Japanese yen has grinned higher. That means the yen is weakening further even though the rate differential hasn't widened. This is a pure speculative extension, positioning driven by momentum funds, not fresh fundamental inflow. When momentum carries price beyond the yield spread's anchor, you get sudden mean reversion spikes. That's exactly the kind of environment where the intervention ghost materializes. Japan's Ministry of Finance has shown repeatedly that they don't intervene at a specific level. They intervene when the move is disorderly and speculative. If we get a sharp 80 pip spike above 160.63 on thin liquidity, that is the trigger for verbal intervention first, then potentially actual yen buying operations. So the 1-2-2-week directional lean is still bullish unless 159.28 breaks, but the risk of a 200 pip washout from intervention or a hawkish BOJ surprise is severely underpriced. The exact event that invalidates the bullish lean? A daily close below 159.28, or a BOJ rate hike accompanied by upward revisions to the inflation outlook. If that happens, the support at 158.11 and then 156.27 comes into play fast. Write that down. Do you think the dollar breaks 105 this week? Actually, focus on US dollar to Japanese yen. Type your range for the next 24 hours in the comments right now. Something like 160.00 to 160.80. I'm tracking consensus against institutional flow now. This is the section where most viewers click away, and that's exactly where the money is made. Keep watching, because I'm about to hand you 3 trade plans with exact numbers you can execute today. Before we start, remember the 2 layers of risk here. A BOJ disappointment sparks a melt-up, a BOJ hawkish shock or intervention threat triggers a freefall. We need strategies that exploit both without getting destroyed. Let's begin with strategy 1, the sniper, conservative approach. This is for traders who want high probability entries aligned with the dominant trend but protected against a new spike. The sniper waits for a pullback into the dynamic support zone where the 20-period moving averages on the 4-hour and daily converge. That's the 159.73 to 159.75 region. The exact trigger condition: a 1-hour candle close above 159.80 after a dip that touches 159.73. This confirms that buyers absorbed the selling pressure and are pushing back up. Stop loss goes below the 4-hour demand zone at 159.49, just under S2, which gives a 31 pip stop. Take profit 1 is the pivot to resistance at 160.18, offering a quick 38 pips and a 1 minute and 1.2 seconds reward initially. Take profit 2 is at the high of the resistance cluster, 160.60, adding another 42 pips. The full risk to reward on this trade if you scale out is roughly 1 minute and 2.6 seconds. The setup is void if the daily candle closes below 159.28, because that would violate the higher-low structure and flip the short-term trend bearish. This sniper play lets you ride the trend without chasing the breakout. The sniper, conservative, entry, 159.80, 1H close above after dip to 159.73, stop loss, 159.49 take profit 1, 160.18 take profit 2, 160.60 risk, reward, 1:2.6 invalidation, void if daily close below 159.28 strategy 2, the active trader. This setup is for traders who want to participate in the intraday momentum without waiting for a deep pullback, but still using a well-defined mean reversion entry. Here, we use the 15-minute chart's 20-period moving average, currently around 160.08, as our bounce point. The entry condition: a 15-minute candle close back above 160.12 after a quick flush lower that holds above 159.96. This is a classic moving average bounce with trend. Stop loss is placed at 159.90, just below the pivot and the MA50 on the 15-minute, risking 22 pips. Take profit 1 is set at 160.40, right before the R2 resistance, 28 pips. Once target 1 is hit, move the stop to break even and let the rest run to take profit 2 at 160.62, just under the R3 level where profit taking is likely. The total potential gain is 50 pips, delivering a risk to reward of 1 minute and 2.3 seconds. A trailing stop rule: after TP1 is reached, trail the stop by 15 pips on the remaining position. This setup fails if the 1-hour candle closes below 159.96, because that negates the intraday bullish structure. Type your US dollar to Japanese yen range for tomorrow in the comments now. Are you seeing 160.80 or 159.50? Let's see who's aligned with the smart money. The active trader, standard, entry, 160.12, 15M close above, after hold above 159.96, stop loss, 159.90 take profit 1, 160.40, then move stop to break even, take profit 2, 160.62 risk, reward, 1:2.3 R invalidation, 1H close below 159.96 strategy 3, the aggressor. This is a high-risk, high-reward counter-trend play designed for the moment when intervention fears or a BOJ headline spike price into an unsustainable level and you want to fade the panic. This setup uses a 5-minute chart extreme. The trigger: after a sharp 40 pip or more spike that breaks above 160.63 and prints a 5-minute bearish engulfing candle closing below 160.55, you enter short on that candle close. The entry would be around 160.53. Stop loss is tight at 160.72, just above the spike high, risking 19 pips. Take profit 1 is the 20-period MA on the 5-minute at that time, likely around 160.20, 433 pips. Take profit 2 is the pivot at 159.96, 4. Another 24 pips. Risk to reward on this fader is 1 minute and 3 seconds. This trade must be managed aggressively. If the 5-minute candle immediately reverses and closes above 160.63 again, scratch the trade. Only for those who can lose small and act fast. The intervention ghost loves to hammer down a 60-pip candle. This setup puts you on the right side of that liquidation. The aggressor, high risk, entry, 160.53, 5M bearish engulfing close after spike above 160.63, stop loss, 160.72 take profit 1, 160.20 take profit 2, 159.96 risk, reward, 1:3.0 R invalidation, 5M close back above 160.63, or if no spike occurs before you place any of these trades, absorb this risk management pulse because it's the difference between surviving and blowing up. Never risk more than 1 to 2% per trade. No positions through high-impact news. That means no holding into the BOJ statement without a guaranteed stop and a plan for slippage. Stops are non-negotiable. If 160.63 breaks and you're short without a stop, you're looking at a melt-up that could run to 162. This is how you survive to trade the next big move. Let's close with the single most critical level for the next session and a tease for tomorrow. The number that separates the bull trend from intervention chaos is 160.63. If we open above it and hold, the melt-up is on and the 161.50 zone becomes the target. If we spike and fail, that is your intervention freefall signal toward 159.28 and then 158.11. Tomorrow's focus is the BOJ preview blackout period ending and a potential leak to the Nike newspaper. If a hawkish story drops, the reset could happen before the decision. If you want the full breakdown on Bitcoin and the S&P divergence that's flashing the exact opposite signal of what retail thinks, that video is live now. Tap the end screen. Smash like if this gave you a clear plan. Subscribe, hit the bell, and I'll see you in the next one with the numbers that matter before the herd even wakes up.